All right, so how do the reverse mortgages HECM work? So there's no required monthly mortgage payments. All right, so basically, let's break this down. So let's say you have a $100,000 reverse mortgage. Okay, so that's what you took. You took out a $100,000 reverse mortgage. On a traditional mortgage, you're paying that principal and interest back each month. On a reverse mortgage, you're not paying that principal and interest back. The interest is actually adding to that $100,000. So each month, whatever that interest would be adds to the $100,000. Over time, that just continues to grow. But now there's specific, and we're going to get into this in a little more details. There's specific requirements in the way they structure this for the retiree, so that they don't eat up the equity, eat up all the equity. As a matter of fact, over time, the value is going to grow more than the balance of your mortgage, and we'll show you that in a minute. Qualifying, some of the basic qualifying requirements. It has to be your primary residence, so they have to live in it as their primary. One of the borrowers must be 62 or older, assuming you have a spouse or somebody else in the household. If they're under, you can still do it as long as they're 62 or above. They are coming out with some new products now in the reverse mortgage industry that you can actually go to the age 55. Okay, so there's different restrictions and different things on how that works. But you can do some reverse mortgages in most states at 55 years old. You must typically meet a minimum equity requirement. This is one of the most difficult things. Typically it's 60 to 70% depending on age and interest rate. So basically when they calculate, there's a formula for the reverse mortgage that looks at what's the property value, what's the age of the borrower, and 62 is very young in reverse mortgage age. And what are the current interest rates? And with the current interest rates that are a little bit higher right now, it forces that down payment or that equity position to be a lot higher than it usually is. So if you're looking to do a reverse mortgage, you've got to make sure you're going to maintain about 60 or 70% equity position in the home. Or if you're doing a reverse mortgage for purchase, you could be looking to 30 to 40% down as a requirement. And we'll talk about that. It can be a refinance or a purchase with the reverse. If anybody has any questions on the slides that I'm doing, jump in. But everything makes sense so far? So good? Okay, what are the basic loan types? The fixed rate option, and I'm going to tell you right now, like less than 3% use the fixed rate option because you do have a fixed rate. Right now the fixed rates are much higher than the adjustable. There's only one draw, that's it. You can only get a certain amount. It's usually not as much as the adjustable version. You can't get any future draws. It's basically set it, forget it. It's fixed rate and a certain amount you get at closing and you're done. The adjustable rate version, where the rate is significantly lower, but it's also protected by caps. So the rate can't adjust higher or lower more than a certain amount. So they're protected on that. They're only charged for the money borrowed, which kind of like we went over. They only get the interest for whatever they've used. Mainly what most people do on a reverse mortgage with the adjustable rate is they get a line of credit. So they keep a line of credit that they can use and they can access for liquidity anytime they want. And the interest calculation only goes on what part of the credit line is actually being used. So if they have a $100,000 credit line that's sitting there they can access anytime they want, they're not charging interest on the whole $100,000 unless the whole $100,000 is used. They're only using $20,000 of it, they're only getting charged interest on the $20,000. Make sense? So line of credit is probably the most popular. You can do tenure, you can do term, meaning basically you can get $500 or $1,000 a month for 5 years, 10 years. You can get a certain amount for the remaining time you live in the home. So there's different ways to structure it. It's just going to be depending on how much equity they have, their age, the formula, and everything. So we have formula calculations for every option there. Yeah.
So for the growth line, at what point does that kick in? Is it at the time of them actually getting the reverse mortgage on the home?
What, the line?
Yeah, for the line of, when do they apply for it? Like, can they have reverse and then later come back and ask for a line of credit?
No, you get you choose your structure up front when you do the reverse mortgage. Okay. So you choose whether you want to take the equity line, and when we do an assessment or we sat with the borrower, potential borrower, we'll go over, here's what you can do in terms of a credit line, here's what you can do in terms of a term if you want to get money back, or here's a combination. We could do a small credit line and then you can get a certain amount of money back for however many years or the life, and we can calculate that out for them. But once we do the reverse mortgage, that's when everything goes into effect. There's no going back and changing it later unless you refinance it. Make sense?
Yeah.
Okay. But the cool thing about the road line of credit, that line of credit can actually grow with the appreciation of your home. So let's say you take a $100,000 line of credit, and I'm the proponent. I think everybody should have some type of line of credit, whether they have a regular line of credit, a home equity line on their house that they don't need, but they can use if they need liquidity, or a reverse mortgage. You can take $100,000 or whatever it is you qualify for, and if you don't, the portion of the line of credit that you don't use will actually grow 4.5% to 5% per year, right? So each year that goes up. So some people will get a line of credit now just so they have it in the future, and their line of credit that starts out at 100,000, 10 years from now might be 150,000 or something like that. So they have more access as they get older. So there's a lot of cool features to it.
All right, so let's say I got a client that has a house and it's worth $500,000, right? And then let's say they say, hey, I want to do a reverse mortgage because I need cash out of this home, right? Let's say they need, or let's say $200,000.
Okay.
So they call you, they say, hey, I need to pull 200 grand out. What portion of that is the reverse mortgage and what portion of that will be the line of credit? Like, how does that conversation go?
The whole thing is the same.
So it's considered, so that reverse mortgage is considered the line of credit of the money that I'm actually putting?
Right.
Okay.
Any of the types that we talked about is the reverse mortgage. They could just be, the money can be given to you in a line of credit, in term, or in tenure.
So they can use it like a line of credit, or can they pull the whole thing and say, I need all?
There's limitations the first year to how much you can pull.
Got it, okay.
So there are limitations, so it depends on their individual situation. So every person, every potential reverse mortgage borrower has a different situation, and based on however we calculate their specific formula can determine what they can do. Yeah, good question. Does this make sense? So they have a lot of different options based on what they need. So there's a lot of different things that we can do. All right, so I forgot, who was it this morning? Somebody told me that, oh yeah, I heard the reverse mortgage, she might not be in here, but reverse mortgages I heard are really bad. They were really bad. So if we go back to the 80s and early 90s, the old reverse was designed with the bank in mind. You get high rates, low equity reserves were required, and they failed to protect spouses. In the old days, as a matter of fact, what could happen is, over time, is the value of the home would go down below where your mortgage was, and as soon as that would hit, the bank would take over, and you no longer own the home, okay? So you could be forced out, different things, situation like that. So that put a huge, really black eye on the reverse mortgage for years. It's taken them time to get back, figure out how to structure it so that this doesn't ever happen again, right? So there are so many protections now for that potential buyer that they're not going to be in anything like that situation. We'll talk about it again here in a minute. Designed for the homeowner and protects the equity. You have lower rates, higher equity reserves, and protects both spouses. Now they require a much bigger equity position, okay? Much bigger equity position, so over time, as that interest increases, they're not going to go upside down in most cases, right? Even if we had a massive 2008, 2009 crash, which a lot of this was designed on, you still should be able to catch up and still have equity in the home. So here's an example of the changes to equity. So under the first graph up top is expected remaining equity under the old terms. So you can see you start off with your much higher equity position there, and over time as you get older, that interest eats away at all your equity, and at the end you don't have anything. You don't have a house. Under the expected remaining equity new terms, you can see the way they structured is you're required up front to have a lot more equity in the house. And over time, your equity position, even if the mortgage is increasing interest, you're still gonna appreciate, and you're still gonna have more equity, and your equity is gonna grow in most cases based on these assumptions. So they've used these actuarial tables, and they've put all these formulas and things together to make sure that the protections are there.
I do have another question.
Yeah.
So if we go back for a second. So for that equity projection, did it change based on what they know now about how equity is increasing in the market? Or, because you said before, once they equity met what the value was, they would call the loan, I guess, right?
Those were the old days.
That was the old days. So now are they actually giving the borrower room to say, even if it dips, we know that there is an expectation that the equity will still come around? Is that why it changed? Like when they
Yeah.
say
Good
the new,
question.
under the new terms?
So up top, in the top, under the old term, they gave you the majority of your value of your home. They would give you the majority of that equity out up front. Okay, so they put you in a terrible position, right? Down here, now they're not giving you. That's one of the hardest things about the reverse mortgage industry. You gotta have equity in the home or you gotta have a significant amount down. So what happens here is they've got such a significant amount of equity in the home already, and the way it's designed, that the value of the home and equity position is gonna grow over time.
Got it, makes sense.
Right.
Yeah.
Good
I have
question.
a question.
Yeah.
On the old way, now that you're saying that the bank used to take it back, what do they do now if the value of the home is higher? And how, I might get ahead of myself if they,
I'm gonna get to that in just a second. That's the most important question.
It is, I was thinking that. I'm like,
how do they get out? Do they refi? How do they get out is what I want to know.
Yeah, we'll talk about that in a second. So, but keep that in your mind, yeah.
I don't think mine is related, but when you said, basically I'm trying to understand the whole, thing about this. There was mention about the interest rate basically increasing and causing like to kind of run together with the equity either increasing or decreasing. But if I understand correctly, there was on the other side an option where you had a fixed interest rate. So that would kind of prevent that where you keep saying the interest is eating away at it, or?
When I say the interest is eating away, is remember you start with your balance, whatever your reverse mortgage is. Okay, whether your interest rate is fixed or your interest rate is adjustable, whatever the interest rate is, it adds to that $100,000 balance. So at the end of the first year, that $100,000 balance, after you add the interest for the year, might be $107,000 or whatever. And then the next year might be $114,000 or $115,000. So no matter what the rate is, you're eating up the equity or some of the equity by increasing the interest.
Gotcha.
each year.
because they're not paying
Right.
that interest.
And that's the
They're
thing,
not
so they're
paying.
not making payments
They're
They're
on
not
it.
making payments, so the
Yeah.
interest adds to the loan.
So
Okay.
when does, I don't know, when does the payment come then?
The payment comes at the end.
At the end of the mortgage
Yeah,
term?
and we're gonna talk about that too.
Oh, okay.
At the end of the term, when the borrower passes, or whoever is on the loan passes, then they're going to give it to their heirs, okay? And the heir's gonna have some choices on what they can do because the loan has to be terminated at that point in time.
Oh.
Yep.
Gotcha.
You got great questions, it's coming, it's coming. So just an example, just so this would be used like 50% down when the rates were a little bit lower. You can see if somebody has a $400,000, they put $200,000 down and they have a $200,000 mortgage balance, their day one equity is 200 grand, right? So after year one, if the value of the home goes to 416, the mortgage balance is 210. Now with the interest added, now they have 206,000. So their equity still has increased. After 10 years, you can see what the mortgage balance would be, because remember the mortgage balance keeps increasing with the interest, and you still have equity based on this. And after 25 years, you still have equity, right? So you haven't eaten up all your equity. You're still growing some equity the way they set it up. It's just like you're not going to have a $1 million home at the end of 25 years and own it free and clear. You're going to have the $1 million home with a portion of that, mortgage eating up some of that equity, right? But you should. Does all make sense?
Yeah, this is somewhat.
Yeah, I'm
All right,
good.
so let me just make sure, because I want to jump into some of the. So I was going to give you some
So they're
examples.
assuming
I'm
that
just trying to figure out the benefit.
huh?
I'm just trying to connect the dots to the benefit of doing it
Oh, these-
and being able to explain that.
This is the home value, but you must have traded.
Okay.
Correct.
So let's go back to your questions. Okay, you said at the end, that's actually one of the questions that are in.
That's good
Thank you.
though. So you asked them.
So, we'll reiterate, I'll just go into that. So at the end of the day, so the borrower passes away, the heirs get it. As part of the reverse mortgage process, they have insurance up front, just like FHA, and most reverse mortgages are FHA. But they have what's called upfront mortgage insurance premium, right? So that's part of the cost to the buyer when they start the process of the reverse mortgage, so they have that. And that insurance upfront covers them from never going upside down. So that insurance would kick in if the value of the home dropped below the mortgage balance, which it shouldn't, but if it did, that kicks in, all right? So now, if they transfer the loan, goes to their heirs are gonna have to sell it, refinance it, do something with the house, they can no longer have the loan, but they don't have to worry about getting a home that's upside down and having the debt on them. So we'll talk a little bit more about that in the questions that you answer. Was there another one? Somebody was asking me something else.
So how do they, when they're going through that process, because I have a family friend of mine that's going through that now,
Okay.
they keep telling them the appraisal went out, the home is now appraising under the value than what the reverse mortgage is, and they're saying that we couldn't go through with the deal.
When they go do the appraisal is, so what they're probably saying is they probably ran a calculation based on the age of the borrower, okay? They're looked at the value of the home, so let's say it's $500,000, okay? That borrower would have to have, I'm just making an assumption, 60% equity in there, or 60% down, all right? So if your friend or relative or whoever, if they don't have that much equity in the home or that much to put down, based on what the appraised value would be, then they may not qualify for a reverse mortgage. The equity position is the most difficult part for that person to qualify for it. You have to have significant equity based on the age. It's a protection that makes sure that they're not going to go upside down later on also. So that might be, but if you want to let them, if you have any other questions on that or if you want to find a little bit more detail, I'm happy to even speak with them if they want to understand what's going on.
The money down option can't be pulled from the equity, right? Like you said, they either have to have 60% or, for example, 60% or that amount down. So they would have to have that money separate to put down.
There's two versions here. So one is a refinance. So let's say a person owns their home free and clear. So you own a $500,000 home. We do a formula because they want to take some equity out. They want to take some equity out. So they can take out, let's say, 40% of that $500,000, right? So a couple $100,000. So based on the formula, they can take the $200,000 out as a reverse mortgage. They can do it as a credit line. They can do it as a over time, whatever they want. That's scenario one. Scenario two would be somebody that doesn't own a home that wants to buy that $500,000 home, right? They don't want to pay cash, but they want to put the minimum they can down and they don't want to have a mortgage payment, right? So we run the same formula. In this case, they need to put the $200,000 as a down payment. They put the $200,000 as a down payment. They buy the $500,000 house as a reverse mortgage. They don't have a mortgage.
And the payments are coming out of that equity, that $300,000.
Yeah.
Because if you find, right, am I saying that correctly?
Correct.
That payment is, so if he puts down 200, he doesn't have a payment because he still has equity in the home that they can kind of.
So you have a $200,000,
can go from.
you have a $200,000 loan if you bought a house with a reverse purchase, and that $200,000 now starts the clock. Whatever your interest rate is, your interest adds to that $200,000 over time.
Okay, that was a better breakdown. Yeah.
Well, I know, it requires you to reverse the way you think about how a traditional mortgage is.
I was thinking of the first option as in, they own it free and clear and they're just doing a reverse mortgage.
Right. So
now I'm aware of the second option.
that's
you're
the
wanting
thing.
to
That's
buy.
the thing that's important for you all to understand too, is that you can buy, your client doesn't have to pay cash, or you might have a client that is in a situation that they can't qualify for a conventional loan, and we'll talk about some scenarios. But now they have the opportunity, if they have a significant down, they can do this without having a mortgage payment and still qualify. Maybe they have bad credit, they can't get a conventional loan. Or maybe they've got to do it this way, they won't qualify because they don't have enough money in income. All they have is Social Security, so the reverse mortgage gives them that opportunity. All right, so let's go through a couple of scenarios. So Widow Sophia, you know the Golden Girls? There it is, Widow Sophia. She lost her husband's income when he passed away. So she has her house, she wants to keep the house. So the benefit of a reverse mortgage for her would eliminate the mortgage payment, consolidate some debt. She has some debt that she had to consolidate. She has a line of credit now for liquidity that she can use for future needs. And then she's got financial peace of mind and flexibility to be with her family. So in this case, Widow Sophia was able to keep her house, right? Consolidate some debt, eliminate having a mortgage payment so that she could live off her Social Security or whatever was left. So this is an example of a person, and this happens a lot. And the majority of the loans that I'm doing these days have to do with somebody who wants to keep their house. They own it free and clear, or they have significant equity in it. They run out of their savings. They don't have any savings left that they've had, and all they have is Social Security or whatever income. So the only money they have, or the liquidity option, is from their house. And so this puts them in a situation that they can do so many things. I had one lady wanted to live in her home, owned it free and clear, but she was past due on her property taxes, needed a new roof, had like $4,000 in savings left, and she didn't know what to do. We did the reverse mortgage, gave her an equity line. She took enough money out initially to pay her roof and her taxes back, take a little bit more out for some other needs, and then she basically had a line that she could use whenever she needed in the future. Yep.
Does it work with any other loans in addition to the mortgage? So let's say, for example, with the older community, they have these options where they come in and do home improvement, but it's somewhat of a lien somewhat on the home, or they have to wait 10
They won't be able
years.
to do that. So you
Okay.
can't do this with down payment assistance. You can't do this with any, other second mortgages and stuff. Now, there are reverse mortgage seconds, but that's a whole nother. I'm not even.
Yeah.
We're going basic. All right, another scenario. A couple 75 years old, they sold their home to downsize. They have $300,000 now. That's all they really have. They don't want to have any mortgage payments. So there's a couple of options they can do with a purchase. So they could buy a $300,000 home with their cash, right? That's easy, right? That's what most of us done. And then they'd have no money left. So if any emergencies or anything came up, their money is used. $300,000 went into the house. Or they could buy a $300,000 home with $160,000 down and $140,000 left cash in their pocket. So now they bought the same $300,000 home. They used the reverse to get a $140,000 reverse loan, and now they own the home and they have $160,000 that they can keep in their retirement accounts or whatever, and they have liquidity. Third option, maybe they want to buy more of a house. Maybe they thought they could only do a $300,000 house because that's all the cash they had, and they can't qualify for a conventional loan, right? Well, they could take that $300,000, put that down on a $560,000 home. Now they can buy a higher priced house. They wouldn't have qualified at all on any type of conventional loan. They would have thought that they could only buy the house with cash, but now they can buy a $560,000 home, put the $300,000 down, not have a mortgage payment. Okay? Now all of a sudden you increase their ability to buy. Okay? Does that make sense? All right, so Richard Branson, owns a $850,000 home free and clear, okay? So what he does is he sets up a $400,000 credit line. And again, remember, each borrower is slightly different on what they can do, but let's just make an assumption, $400,000 line of credit. Now he can use this line of credit over the next few years to invest in specific investments. There are certain things that they can't invest in. They can use it to flip a home. They could use it to buy income-produced rental properties. They could use it to help kids, whatever. But I actually had somebody who wanted to do this, wanted to pull some money out, and he's kind of retired. All he does is fix and flip some homes. So he just needed something that he could pull from equity, fix the house, sell it, and then pop it back. He could pay the revert. He could go and put the money back in. So it's almost like an equity line. So if you take the money out, you can actually pay it back down. Okay. So that's what they do. So there's a lot of different creative ways to do it. So he increases his wealth by putting his equity to work. Make sense? All right, so Crystal Ball says short-term demand for HECMs or reverse mortgages will boom. Why? Because there's a higher cost of living. Because over the last few years, everything has cost more, right? I mean, real estate, everything. Cost of living has exploded, and a lot of these, and their income with Social Security or their pension hasn't gone up to go along with our inflation. In 2009 was the peak. What this tells you is basically during tougher economic conditions, higher costs and things like that, the demand for the reverse mortgages increase. So I think now you're starting to see them, this goes to 2022, but I think you're starting to see them come up a lot in the most recent years. We're starting to see more people have interest in them. Midterm demand for HECMs will boom. Why? Because we're gonna have lower interest rates, and that's gonna allow them to take out more equity or put less down. Ideally, knock on wood, if we thought it would happen by now, into next year, we'll start to see rates continue to go a little bit lower, and that'll give them a little bit more flexibility also on the reverse mortgage side. Benefits to real estate agents. All right, benefits to you all. Improved market reach. Hopefully, we've already gone through some scenarios that you didn't even know existed out there that you can use if it triggers and you're talking to a client. Attract and capture new and rapidly growing market of home buyers. Remember, baby boomers are the biggest segment in real estate in the United States. Baby boomers. They have more equity in their homes. They own more homes than any other segment. Additional spending power, so they may have untapped equity there that they can use. I'll get to it in a second. More home for less money, like we said, they can buy more home for less money. They don't have to pay cash. They can pull out additional funds from their equity of their main home, and they can buy a second home or investment. They can use their additional funds to help kids buy homes. That's a good example. Some people have taken some money out with a reverse mortgage to help the kids buy. And then it's easier qualification for credit income. How many times do you have clients that just don't qualify? Maybe they have a lot of money, but they don't qualify for any type of conventional loan. And it happens a lot, whether it's credit or not enough income. You have somebody that might have $1 million in the bank, but they only have Social Security and maybe a little bit of interest income, and they don't qualify for the amount of home that they want to buy when you add taxes and insurance. But with something like this, they could.
So if I have a client that he would need, how much would you say he would need for a $300,000 home that he doesn't have, like you said, the qualification of credit and the income? What would you say on average he would need?
Yeah, it's probably anywhere from 30 to 40% going down right now.
So if he has 30 to 40% down, he could probably, even though the credit.
Excuse me, it's the reverse. Let's say you have an equity line or a line of credit from a reverse mortgage, and you're pulling from your retirement now when the market is like down, right? You don't really want to pull it when it's down, right? You want to let it sit and get back to where it is. You don't want to have to touch it where it's possible, but you can use the liquidity from your home, from a reverse mortgage, and keep your money in your retirement accounts or anything like that and let that around. So that's a big deal for financial planners and CPAs. You can delay Social Security and pension payouts. I think you have to take Social Security now by the time you're age 70, but you get more if you wait until you're 70 versus taking it when you're 62. So a lot of people feel like they have to get that, it's their only option. But if they have the ability to get a reverse mortgage, maybe they have a pension or whatever, get the reverse mortgage, then they can wait and get their Social Security later, and they'll get more money, okay? Draw tax-free. Again, we said your home equity is tax-free if you take it out. Postpone drawing on retirement funds. Purchase a new home with a reverse without paying cash. So a lot of people will go to their retirement accounts and pull the money out to buy their house or to do something if they want to, when they didn't realize that they can use the equity in their home if they've got it. Establish a growing line of credit for future needs and opportunities. Remember, that line of credit, if you don't use it, will grow. All right, so long-term demand for reverse mortgages are going to boom because of product acceptance. I guarantee you everybody in this room now knows a lot more, has a lot more knowledge on something in the real estate industry that you didn't even know existed. It's not for everyone, okay? You still have to have significant equity, certain needs that would meet what a reverse mortgage does. But for those that it does qualify or those that it can help, it can be a game changer or a life changer. And here you go, you see baby boomers, 76 million. The biggest, and they're still retiring now at massive paces right now. So we have a big segment right now that we're not tapping into. All right, I'm going to pull Ashley up here.
Our questions are here for everyone to see, but I think one of the major questions probably now in the room, with everyone here being mostly realtors, why should real estate professionals actually develop a real understanding, right, of the reverse mortgages, right? And how can that help us serve more clients? All right, I'm sure people want to know that.
Yep. Okay, so to reiterate on some of that, again, baby boomers, and that segment of real estate is the #1 segment that owns real estate in the current They have family that wants to buy real estate, first-time home buyers. You now know that you can qualify somebody that doesn't have great credit terms or doesn't have a lot of significant income. That you would just say, I'm sorry, they don't qualify for a conventional loan and move on, not knowing their situation that this would be out there. So now you have a lot more knowledge that, depending on your conversation with a client, that might be able to fit in a reverse mortgage down the road.
So I'm gonna do part 2 to that, because I know one of our questions is like, in what situations would it make sense? But what are some trigger words, right? If I'm at the table with a client, maybe I'm doing a buyer's consultation, or maybe I'm doing a seller strategy listing presentation. What are some key words should I be looking for that will say to me, oh my God, a reverse mortgage might work for this person? And maybe I don't know how to explain it, so do we just pass it to you? Or how much should we know at that table to really say this may work? You know what I mean?
Well, it's a great question. You're having your discovery call or your consultation. Obviously, age, you have to be 62, right?
Okay.
So age would be one.
Age.
And then cash is a big one, right?
They need
Because-
money.
Or they
Or
want to
have
buy
equity.
cash, or they want to pay cash
Okay.
for a house,
Okay.
right? Or you can let them know that's not the only option that they have. They could look at something else.
Okay.
Concerns over qualification is a big one.
Okay.
Concerns over qualification credit. Those probably are some of the biggest ones.
So if someone's sitting at the table with me, they want to sell their home, and but they're saying they're selling because they don't have any money, right? And then they don't have anything to buy, or they're like, where will I go if I actually do sell? Would
Right.
that be something that
That would be a trigger too, yeah. So if you're selling a house and
they're
they're
saying?
concerned over what they're gonna get next, or,
Yeah.
they're downsizing, that could be a trigger to at least have a conversation on the reverse mortgage.
Okay, all right, does that make sense? And so one of the questions I had too, and I think you kind of went over this, but one of the biggest things that I had a question when I recently met with a client, she was concerned about her heirs because of the stigma that came with people losing their homes. So will my kids get the home, if we do a reverse mortgage and I pass away, will I be able to have my children? How do you have that conversation?
100%, yeah, I think that's one of the questions here
Yeah.
too. Yeah, so when the borrower passes, the heirs most likely are getting it, assuming they have a will and whatever, they're transferring it to the heirs. So the heirs at that point in time are gonna have options. They have a certain amount of time, I think it's usually 6 months. So if the heirs wanna keep the home, okay, then they're gonna either buy it out, whatever the mortgage balance is. So there'll be a mortgage balance at the end, right? They will have equity, but they have to cover that mortgage balance that they're gonna get it. So let's say the mortgage balance is $500. Then they can buy it off $500,000, pay it off, and then they own the home because they inherited it. Or they can refinance if they wanna keep it. So they could refinance that $500,000, whatever, keep it. Or they can sell it, okay? They can sell it and then keep whatever the equity position is after the mortgage is paid. So they have those 3 options. Make sense? I'm gonna tell you this, okay? Everybody, your heirs worry, that's one of the biggest hindrance of us doing reverse mortgage is the heirs don't want them to do it because the heirs want the property, right? Or want the heir property. They don't complain about them using their 401k when they could get their 401k later on, but they want the property. But do you know that it's 1% is the number, the percentage of heirs that actually keep the property that they inherit with a reverse mortgage?
Yeah.
So, hold on.
Is there a requirement of that portion of the will or trust or something in place to ensure that the property is getting passed over to an heir? Or?
Yeah, that's a estate planner question, but yes, you need to make sure that you've got something in place that transfers the property to the heirs.
But on your side, do you all require
No.
to see that? Oh, it's okay.
So it's actually sitting at the table and that buyer literally said they wanted to sell because they just didn't have the money. And in the conversation, they find that maybe the reverse mortgage is the option. Is there a commission paid out? And that term actually converts them to having a good.
Well, actually, it's gonna get if they're selling, she's gonna get
No,
the
but if
commission.
she tells them, okay.
Not for the, yeah.
If they just take that house and they just do a reverse mortgage on that house, refinance in there, and that's it, no. That's just helping them.
But to your point though, because I actually had that scenario where I did sit down with a seller, he ran out of money, he couldn't pay his mortgage, and if he sold, he didn't even have enough money to necessarily buy something that came move-in ready, right?
Okay.
So the option of reverse mortgage came up, and he actually did do the reverse mortgage, right? I didn't get a sell out of it, but this same client was so elated with the idea. He told me about his neighbor across the street, right, that is gonna be selling, and then he also, like, that's a relationship now, because for me, it wasn't just, I wanna sell your home, it was what actually works for you.
Right.
Right, so now this is just another option at the table for us as agents to have, to say, okay, maybe you can't sell because you can't buy, but maybe this is an option, right? And I think that's what will separate us of having more than just buy it or sell it, right? But here's an option, let me educate you, let me bring my partner in to see if this, works for you. All right?
100%, really good.
Yeah, I think somebody else had a question.
What's the time frame for applying for a reverse mortgage till it's actually comes to fruition?
Yeah, so it can be done in 30 days. So basically, we set up a discovery call like we do a consultation with the client, just get the basics. We gotta figure out what amount they would need as a down payment or what amount they would need as equity. We do that, give them a little bit of an idea. Then they're required to go see a HUD counselor, okay? This they can do over the phone. I set up a little package based on their scenario. We send it to the HUD counselor and to them. And the HUD counselor acts as a third party to protect so that it's not just the mortgage or the loan officer that's doing it. They're seeing a third party person that's separate, and they review the information with them to make sure they understand it and everything like that. Then once they've gotten that certificate that they met with the HUD counselor, then we start the application process. We get the documents that we need, they run the credit, and running the credit really just to see, what debts they have. If they have really massive issues with their credit, they may require to set aside a little bit, almost like an escrow account for taxes, insurance, to make sure those get paid for a certain amount of time. But that doesn't happen that often. So anyway, then you just, like a regular, once you get past the HUD counselor, you're getting the application, the credit, the appraisal, those type of things, just like you would a regular loan.
I think we got one more. Did you have a question too? I guess, okay.
One thing that I wanted to reiterate, is it on there? Okay, can repayment be triggered before the owner passes away? The answer is
That
yes.
was a question that, Tara had. Can the repayment be triggered?
It
Okay.
can. But not unless they leave the home and it's no longer their primary residence. Okay, that's the biggest. They always have to live in the home as their primary. If they moved out of the home and it's no longer their primary residence, then that could re-trigger the repayment, right?
That was a
Okay,
question.
sell the home. If they're not paying their taxes and their insurance, or they're in default on their taxes, their insurance, or their HOA goes into like a list pendant or anything against them, then they could default the reverse, because the reverse mortgage documents require them to keep up with the taxes, the insurance, HOA, or anything like that, and the condition of the home.
Yeah. Oh,
I have 3 questions.
Okay.
My first question is, if you had to describe a reverse mortgage in 7 words, what would those 7 words be?
Mine would be, what the heck is a HECM?
I would say a reverse mortgage is a life changer for the right person.
Okay, 5 words, good. And then if my second question is, if you could describe a reverse mortgage in 3 words, what would it be?
Help is here. Or this is.
Option for liquidity.
Option for liquidity. And then my last question is, if you could describe a reverse mortgage in 1 word, what would it be?
Liquidity.
I would use liquidity again, but game changer.
Yeah, I like it. I'll take
I have one
those.
more
With the
question.
hyphen.
Yeah.
I have one more follow-up to the triggering of it being prior to them passing away, considering the age, if they were to go to like a nursing home or facility like that. I know that's like, real like, is that something that could trigger it?
It could, because now they're no longer living in it as a primary. They've been moved to a primary home, so that they would have to sell the home, or they can have their heirs take it over at that point in
That
time.
does trigger it, because they move out, it's no longer their primary, and now the other facility is their primary. So it could trigger it.
Yep.
Yeah, yeah, but it's a great option, right? Because here's the reality, you're sitting at a table and a seller, maybe they're only gonna have 120,000 in equity, right? And once they sell, but you can take that 120 and make that be 60 or 70% of a down payment where they can actually purchase a home with a reverse mortgage, right? So it's options there for your sellers, and I say even buyers, just to be able to like educate a little bit more on it. That's kind of why I got into it with Steve, because baby boomers are running out of money. Right, they don't have the Social Security that they were seeing before, the confidence is not there, and this is just another way for us to show up as an advisor when it comes to the real estate.
And there's so many people now that have so much equity in their home. Think about the last 5 years on how their equity's basically doubled. And a lot of people have had to, they don't know how to access their equity other than maybe a home equity line of credit, and sometimes they just don't qualify for that. So with increased costs, increased across the board costs, knowing that they can tap that equity in one way, shape, or form is can be really big.
Yeah, that's good.
Oh, go back to your, if they do go to like a retirement home or something like that, then maybe it's time to sell the house. You're gonna have equity in most cases in it. You sell the house, you put that money aside for your long-term health or the cost of the home too. So there's always different ways to work through that. All right, did we hit everything here?
I think so.
Okay, let me touch
Fees.
base with the fees. Okay, reverse mortgage costs upfront are higher than your standard loans. Mainly because of two things. Number one is that upfront mortgage insurance, right? It's 2% of the value of the home. They collect that up, it's insurance, and it protects the heirs. So you're gonna have that on any type of loan, there's no way around it, right? That's their protection. And then you're gonna have, usually there's an origination point or two in there. Because remember, the lender doesn't make money on this for the most part until the end. So there's some basic upfront, usually origination charges that are in there. And then you have your standard title and recording and stamps on and taxes, those type of things. So you have those standards, all right? So you do have a little bit more on the front end on costs.
But they're not paying out of pocket, that could be put in the loan.
That's all in the loan.
Okay.
Yeah, 100%. Yeah, they're not coming out of pocket. Now, if you did a reverse mortgage purchase, and we can get creative here, and they wanted to make sure they can put the minimum they needed to down, we can get the seller to pay up to 6% on an FHA. So the seller could actually pay for a lot of that stuff in there. The 2%, more insurance, they do that. So we could structure it kind of creatively there.
Very good.
Cool?
Any other questions?
Yes, sir.
If I wanted to learn more, like casually, on the go, on my phone, where should I go to find more information?
DM me at Steve Strongwell. Is that my trick question? Awesome. Well, want to thank everybody for coming. Were there any last questions?
Ashley, you wanna plug yourself as well?
And
What?
it can be found.
Okay, well, I can be found on, I am Ashley McCoy on Instagram. Gotta get a clap.
And again, I checked that out because she did a really good job. We went over some of the same things, but there's always certain things that you may pick up on if you take a look at it. So that's there. And then, my guys over here, Raphael and Malik, if you need, I know Ashley's got a great marketing team too. These guys do all my YouTube videos. If you see the Steve talking to Steve stuff, and then the Salty Steve's coming, so they do all that kind of stuff. So they can do stuff that might be able to help you too. So anyway, thanks again.
Yeah.
Awesome.
Thank you.